Graceman Knowledge of GMK. Welcome to my YouTube channel, where you are taught all you need to know about accounting, finance, and lots more. Remember to like, share, and subscribe.
In this episode, we'll be looking at IAS 2. What's IAS 2 talking about? IAS 2 is talking about inventories. IAS 2 prescribes the accounting treatment for inventory with respect to the measurement and recognition of inventories in the books of account. Now, what are inventories? Inventories are assets held for sale in the ordinary course of business. You agree with me that every business is either producing goods or service. In a situation where a an entity is into sale or manufacturing of goods, inventory is applicable to such inventory. And that is why we have inventories as asset held for sale in the ordinary course of business. And inventories can be what? Can be subdivided into one, goods purchase. You remember that the definition of purchase is purchases are goods bought for resale. So any good that is bought for resale is what qualifies for inventory. Now, also raw material. Note that you are either purchasing to resell, you can also be purchasing to what? To produce. Meaning that whatever you are buying is to be converted into finished goods. So if you are buying raw materials to what? To convert to finished goods, such raw material also qualifies for inventory. We also have work in progress. It simply means that the raw material you have purchased, in the course of conversion, if you have some still yet to be converted to the final output at the end of the year, those ones will qualify for work in progress. And note that because they are part of what you are, they are the raw material that you are converting to the finished goods. In the process, they still qualify for what? Inventory, while they are still work in progress. Another concept that qualifies for inventory here is what? Is finished goods. Now, what are finished goods? Finished goods are the what? Are the final output of the raw materials we have in. This simply means that at this point, what is remaining is for what? For the final, that the finished goods is the final output, which is what? Which also qualifies for finished goods. And what that simply means is that they are ready to be what? To be sold out. Now, the difference between these goods purchased and held for sale and finished goods. Finished goods are also held for sale, but the difference between the two is that these finished goods metamorphosized from raw material to finished goods. Why this? The intention of buying it from the beginning is what is finished goods. A very good example is an individual that bought mobile phones for resale. The idea behind this is not to convert it, is not to add any other kind of value to it. The intention of this person, of this individual, was to buy and to sell. So the purpose of that is to buy and resell. So that qualifies for inventory. Why in this case, say for example, somebody that bought flour to produce bread. So after buying the flour, the person will need to mix it with what? With butter, with what? With sugar, with what? etc. To what? To make this finished good. So all that is added to make it this finished goods, flour qualifies for the inventory, and other things that will be what? That will be chivita, juice, and the rest. Raw materials are so whatever is acquired, whatever is purchased as raw material in the production process qualifies for what? For inventory. Now we go to the measurement of inventory. Inventory should be measured at what? At lower of cost and what? And net realizable value. What does this mean? This simply means that at the end of the accounting year, when inventory is to be measured, it will be recognized in any one of the two that is what? That is less. So that simply means that we have the cost of acquiring the inventory, and we also arrive at the what? At the net realizable value. So let's go into explaining what cost simply means and what net realizable simply means. We can as well say that inventory cost consists of the purchase cost Purchase cost of the inventory: 3 bags of rice at 60,000 naira at what 20,000 naira per bag. That is what purchase cost. Conversion cost, I mentioned this: the labor cost, sugar, butter, etc. And other costs incurred. Other costs incurred would also be the what? The taxes. It could be what? Transport. In as much as they are input, they are costs associated or directly related to the what? To the inventory in what? In concern, in bringing the inventory to the present condition, to the present location. Remember that I mentioned transport and what? And condition. So other costs that are incurred apart from the purchase cost, apart from the conversion cost, must also be what? Must also make up for what? For the cost of the inventory. Now we go to the net realizable value. What is net realizable value? From that word net realizable, that simply means that what? That this is the selling price of the inventory less the what? The cost to sell. Selling price of the inventory less cost to sell. Now let me take time to explain this further. Why is the standard saying that we use less of cost or net realizable value? We know well that the realizable value must have factored in profit. So that simply means that using the less of the two will mean that it is almost impossible, other things being equal, for the net realizable value to be less than the cost. We have exemption for that. That is possible. There are exemption for that. But in a normal situation, cost should never be more than net realizable value. When we talk about net realizable value, we are talking about the estimated selling price of the inventory, right? Less the cost to sell. Cost to sell could be cost of advert, cost to sell could be marketing cost of the same inventory. So the difference between the estimated selling price of an inventory and the cost to sell will give us what? Net realizable value. The standard is saying that in a situation where we have our net realizable value and cost, we use the one that is less. And let me explain this. If cost is less than net realizable value, it is natural. I will use that word natural. So that means that we will use the word cost. But in a situation where net realizable value is less than cost, this is equal to what? Impairment. And that simply means that the what? That the inventory in concern has been impaired. And I want you to know something. Though when we do IAS 36, impairment of asset would, would explain more in detail, but just for the purpose of IAS 2, I would like to do some exposition too on how IAS 2 is affected by impairment and the treatment of such situation. So when NRV, net realizable value, is less than cost, that means it's impairment. You agree with me that we already have the inventory at cost in the books. So that simply means that in a situation where NRV is less than cost, something will happen. And know that having the inventory in the books being an asset is to have a debit balance. And now NRV is less than cost. That simply means that something has to happen to this debit balance to reduce it to the value of NRV. That simply means that in a situation, as I said earlier, where NRV is less than cost, it simply means impairment. So that now means that to reflect this impairment or to reflect the recognition of the valuation of the inventory at net realizable value, it simply means that what? The impairment will be credited to the inventory account. By crediting to the inventory account, it will now give us the what? The net realizable value, which is what? Which is the less between cost and the what? And the net realizable value. Now we go further to explain why net realizable value may be lower than cost. This I said, let me do a little recap here. Naturally, cost should be less than net realizable value naturally. But there are situations that can make net realizable value to be what? To be less than cost. And we'll go into that now. Obsolescence of the product. What does the obsolescence of the product mean? This simply means that what the product has become obsolete. When a product is obsolete, what happens? The selling price of such product will fall. And once the selling price fall, in fact there are times that the selling price will fall even less than the cost, because at that time it has become obsolete. The owner or the seller just wants to sell the goods out of the market. I see a lot of stuff, they will say um, close something sales. Do you understand what I'm saying? So at that point, what they are interested in doing is what is to clear their stock, and what, because the um, products concerned, they are already obsolete. So when products are obsolete, the implication of obsolescence of products is what the selling price will fall. And when selling price is directly related to net realizable value, because we say that net realizable value is the expected selling price less the cost to sell. So once the expected selling price is already less than the cost, that simply means that the net realizable value will be less than the cost. Now, when it is obsolete, so obsolete of product simply means that the seller at that point would not mind selling less than the cost. It can This realizable value may also be lower than cost when there is a physical deterioration in the condition of the inventory. When it is obvious that nobody want to buy this inventory at the price we are attaching to it, because it is obvious that the physical attribute of this inventory has deteriorated, and you know well that the value of a thing can also be attached to the look of the thing per time. So once the physical look of the inventory concern has deteriorated, it can also lead to what? To decrease in the selling price of the same article. And once the selling price has decreased, what happen to the net realizable value? The net realizable value will also what? Will also fall. And once it falls, it will may eventually what? Lead to what? Having it less than the cost. Another reason, another situation where NRV may be less than cost is when the decision of the management of the company, when they decide to sell the product at what? At a loss, and the idea behind this is just for marketing. They can decide to what? To sell. Either they want to expand their market share, or they are doing promotion. So at that point, selling price may go at what? Because once they are selling at loss, that simply means that what? The cost is already what? Greater than the what? Than the selling price. So, and of course, and we know that the selling price is the NRV is a function of what? Is a function of selling price. So once the company's management decide to sell at a loss, doesn't mind selling at a loss, at that point we know well that what? That the cost will definitely be higher than the net realizable value. Another reason why net realizable value may be less than cost is if there is increase in cost or fall in the what? In the sale price. Looking at competition, they want to meet up with competition, like this decision of the management of the company to sell at loss. If a company want to do competition, or they also want to play in the they are also trying to play with the competitors in the industry they are operating in. If the other competitors reduce their price, they also want to reduce their own price so as to be able to what? To compete in the same industry by reducing their price. When the reduction in the price is lower than when the reduction keeps the price lower than the cost, it simply means that what? The net realizable value will definitely be what? Be lower than the cost. And just as you said at the beginning of this, once net realizable value, once it is less than the cost, it simply means that what? There is impairment. And how is impairment treated? Impairment will be what? Will be expensed in the profit or loss account, just so that we get that clear. How is inventory valued? Prior to 2003, the standard IAS 2 requires that inventory can either be valued at LIFO, FIFO or WAC. LIFO is last in first out, FIFO is first in first out, WAC is weighted average cost. But after year 2003, the standard only approves or only requires FIFO, first in first out, and what, and weighted average cost. Let me just explain what the three means. The three simply means, looking at LIFO, LIFO is saying that the last inventory that goes in, it is the cost of the inventory, the price of the inventory that will be used to value what the, that will be the first, that is the price that will be used to value whatever is what will be sold. So the last inventory to go in will be the what, will be the first out when it is time to issue. While for FIFO, FIFO is saying that it is in the order of what, of receipting that the inventory will be what, will be issued. While weighted average is saying that anytime an inventory is to be issued, the weighted average of the prices would be what, would be used as the issuing price. So this is FIFO. Probably if there is need to have an exposition on this, if you need exposition, you can let us know. We can have an extension of this video where we go in depth into FIFO and weighted average with what, with practical examples, and even buttress it with the statement of profit or loss. So we go into this scenario. At the end of the period, the closing inventory of Splendor West Planet, which cost 7 million naira, was planned to be sold at 10 million naira with 300,000 naira cost to sale. We know the condition. Calculate the inventory to be used in what, in the financial statement. The condition is what, inventory is to be valued at what, less of cost and what, and net realizable. Here in this question we have our cost, but we don't have our net realizable value, and we said that the formula for net realizable value is what, estimated selling price minus what, minus cost to sell. Now here our estimated selling price, the sale is what, 10 million naira. Cost to sell is what, 300k. That means our net realizable value will be 9,700,000 naira. Now we have our cost to be equals to what, 7 million. While we have our what, NRV to be equals to what, 9.3 million. Which one is less? The less is what, is the cost. So hence 7 million naira will be used in the financial statement. That's it. Why? Because 7 million naira is less than what, than this. Now let's have the flip side. In a situation where, assume that the cost is 9.3 million while NRV is 7 million. In this situation, the value of NRV would be used in the financial statement. Now, what is the implication of this? This simply means that what, there is an impairment. How do we know that there is an impairment? There is an impairment because NRV is less than what, cost. And what's the formula for what, for impairment? The formula for impairment here will be what, 9.3 million, which is the cost, minus what, 7 million naira for impairment. So my impairment here is what, is 2.3 million naira. So what do I need to do here? What I need to do here, what, with this 3 million naira, is to do what? Is to credit. Okay, let's debit first. Is to debit profit or loss with the what 2.3 million naira, and what and credit inventory with what 2.3 million naira. Showing this in a journal, that will mean that we have our what our impairment in the this thing. I will credit our inventory. Now let me explain something here. Recall that prior to the end of the year, we have this in our what? In our inventory account, right? And now, because NRV is less than what? Than the cost, and the standard is saying that what we use less of the two. So that simply means that to have 7 million in that account, we need to credit inventory with what? With the difference between the NRV and the cost. By crediting the inventory with the 2.3 million, it will give us what? That means the debit balance of inventory after crediting inventory 2.3 million will be the 7 million, which is what we will have in the what? In the statement of financial position of Splendor BS Planet. When we get to impairment of IAS 36, we will explain more in details. Here we have the following information relates to an auto part dealer who owed inventory WXYZ. We have details of the inventory. This is the selling price per inventory. Of course, we know that this selling price will help us to get the net realizable value. Should there be what? Cost to sell. Here we have the purchase of the inventory what? Per unit. Here we have the VAT paid on the inventory. Here we have the what? Transportation cost. And here we have the what? We have the import duty. So looking at this would be used as our net realizable value. Looking at this question, we don't have any cost to sell. This and this will make our what? Our cost, because we said that cost is the purchase cost or consists or comprise of purchase cost, right? Conversion cost and other associated costs. And recall that when I was explaining cost, I said that transport cost is also part of the cost. Any duty paid, tax, VAT, because it is associated to the what? To bringing the inventory to the present location. So they will make up for the cost. And the condition, and this is saying that determine the value to be reflected in the financial statement for the inventory. And we know that the value to be reflected is what? Less of cost and what? And now let's go ahead to get our cost. Our cost will be costs WXYZ. Our cost will be 500. That's our what? Purchase 700, 800, 1,500. We have our VAT is not per unit, so we hold on to that. We have our transport per unit. Our transport is what? 5 naira, 5 naira, 5 naira, 5 naira. We have our what? Import duty per unit. Import duty per unit of what? 50 naira, 100 naira, 150, 200. So this will give us what? 555 naira. This will give us what? 805 naira. This will give us 955 naira. This will give us what? 1,705 naira. So this gives us 1,705 naira. And number of inventory held at the end of the period. Number of inventory. Yeah. Number of inventory at the end of the period is 15,000, 2,000, 5,000. And please note that the assumption here is that VAT is not per unit. VAT is not per unit. So what do? We are multiplying. So having this as our unit cost, we multiply it by the number of inventory held at the end of the period. We have 8.325 million for W, 1.610,000 for X, 5.2 for Y, and 170,500 for X. We added our VAT. Note that I said that our VAT is not per unit, so it's a lump sum. So what do? We added it to what? To this value we have here, and that gave us all this figure. So for our selling price, note that I said that simply because we don't have any cost to sale like marketing, commission, and the rest, we have selling price as what as our net realizable value. That is what we want to compare with our cost, right? And how did you arrive at the selling price? We have our selling price per unit, 800 naira in this case, multiplied by the what? By the number of inventory held at the end of the period for W. So 800 multiplied by 15,000 gave us 12 million. For X, 1,500 multiplied by 2,000 gave us 3 million for X. For Y, 1,000 naira multiplied by 5,500, which is the number of inventory at the end of the period, gave us 5.5 million. Excuse me. Y for Z, 2,500 multiplied by the 100 unit, which is the number of inventory at the end of the period, gave us what? 250,000. So the next question is, which they have to determine the value to be reflected. So what to now what? Decide on the value to be what to be reflected. And note that the condition is what? Is less of cost or less realizable. So we now need to compare the two to know the one that is what? Less, and that is what we recognize in our what? Statement of financial position. For W, between the what? Between the cost and the net realizable value, which one is the lowest? We have the cost, which is what? 8,325 100. We go next to what? We go next to X. For X, it is still what? The cost, 1,610,000. We go next to Y, which is what? 5,252,800. And then we go to Z, and still the lower is still the what? The cost, which is what? 170,900. Hence, this will be what represented the statement of financial position. Thank you so much for watching. Do not forget to like,